All right, why don't we go ahead and get started? So obviously, as you can tell, a new location. So we've done 102 of these, I think, and this is the first one we haven't done in the office. We started in March of last year, so yeah, a little lonely here. That's okay. Anyway, so today we're going to talk a little bit about what's going on, kind of the wider financial advice industry in Australia, and how that can affect everyone that is an investor. And even though we're in a different location, we still need to go through the same housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you. I can't offer any personal advice. The other thing is, for anyone in New Zealand who can actually leave their home, you can go get our FAP off of our website. So that's morningstar.com.au. And the New Zealand regulatory authorities would like you to consult with a financial advisor if you would like personal advice. And then finally, any questions would be appreciated. So, all right, let's get into this. Okay, so there we go. So we're going to talk about Bubbleville. Now, Bubbleville is basically the title of some... oh no, not going well. What did I just do? Sorry about that. We'll try this again. All right, so Bubbleville is a series of articles I wrote just talking about the current financial situation here in Australia, and obviously anyone who has tuned into these in the past know my little rant about bubbles. So it's not too much about that, but I want to talk about the financial advice industry and the ramifications that was going to have in Australia. So let's start this out. So this is a little bit tongue in cheek, but we're going to talk about a bit of a conflict that is going on right now. And this is sort of this classic generational conflict, and it's around financial advice. So we have, and obviously this is all very facetious, but we have old, out of touch white men that young millennials are complaining that the financial services industry is designed to serve. So that is Eisenhower's cabinet. I'm reading a book on Eisenhower, and I thought if I want a good black and white picture of a bunch of older white men, I would use that. Interestingly enough, he actually did appoint a woman to his cabinet, and I cropped her out of the picture. So she was standing right here on the far right, but I thought, it didn't help prove my point. So I just cropped her out, but he did appoint a woman, the second woman that was ever a cabinet secretary in the US. So then we've got the old, out-of-touch white men. Then over here, we have the young, ignorant, and inexperienced millennials. There they are, dressing more fashionably than me, and on their phones. So that is good. Have I stopped sharing again? I'm really bad at this. Anyway, normally I'm better at this. Anyway, there we go. There are the millennials. And where is this coming to a head? Well, it's coming to a head around financial advice. And that's what we're going to talk about today. So first, for those of you that are unaware and what this Bubbleville series was really about, it was talking about how financial advice is being delivered to a new generation of investors. And we'll talk a little bit in the future about sort of who these investors are and how big this new cohort of investors is. But basically, there have been a bunch of people that have entered the market globally, but specifically here in Australia, since that March of 2020 COVID dip. So obviously, I think we've all heard the reasons. People have time on their hands. They potentially have a little more disposable income because they weren't going out or doing anything. And a lot of people have taken interest, which is a good thing, in their own personal finances and have started investing. And we're going to talk a little bit today about where they turn to for advice. But first, let's describe where these people actually turn to advice. Okay, they're turning to social media. And they are turning to all sorts of different areas in social media. And that's really what this Bubbleville piece explored, and is very tongue-in-cheek about that. But we've heard a lot about Reddit, particularly around the GameStop saga in the US. So, of course, it's on Reddit boards where this, generously called a movement was set up to bid up the price of GameStop. We've seen that spread to other stocks as well, AMC, et cetera. So there are boards on Reddit, there are boards on Facebook, there's certainly Twitter, people that you can follow to learn more about investing. A lot of that is kind of individual stock. A lot of that's very male dominated. But there's also been a huge increase, and I think gratifyingly, a lot of women are getting interested in financial services or in personal finance and investing, particularly in last year. And they're more gravitating towards Instagram, TikTok. Obviously, these are big generalizations, but all these different platforms, all these different social media platforms are being used to disseminate what may or may not be financial advice. And we'll get into a little bit what's happening from a regulatory standpoint. But what we've deemed them, there are certainly these boards, but there's also this group of generally younger men and women that are finfluencers. So those are financial influencers. So maybe you guys have heard about regular influencers on social media. A lot of that was around buying specific products where people would amass a huge set of followers and then, of course, market products to them and make money off of that. The same thing is happening in the financial services industry, which has some people concerned. So let's keep going through this. All right, so what is at stake here? Well, what's at stake is the future of financial advice in Australia. So I've taken a couple screenshots from the AFR. So those of you that read a lot of the AFR will see a lot on what is happening in this space. But basically, as these influencers amassed larger and larger followings, the question, of course, has come up is what they are doing, does it constitute financial advice? Because the vast majority of them are not affiliated with a company that has an AFSL. They are not licensed, therefore, to give financial advice, either general advice or personal advice. But in many ways, that's what they're doing. And I think it's something that ASIC is struggling with. And they're struggling with this. Well, they should be struggling with this, whether they are or not. They should be struggling with this because this is, of course, a very vulnerable group of people that are turning towards social media to get advice because they are new investors. They're not as knowledgeable or sophisticated as investors that have obviously had more experience around that. So I'm going to stop sharing now for a second. That one was actually deliberate. Talk a little bit about what has happened in terms of new investors. So what have we seen? So in Australia, we have seen, according to the ASX, 2 million people that have started investing in the past 2 years. So a lot of them are millennial, Gen Z. There are further 900,000 people that intend to start investing in the next 12 months. And of course, this has happened for the reasons I was talking about before, since COVID has hit. But they're starting to have, and retail investors in general, individual investors are having a bigger and bigger influence on the market. So that is what we want to talk about today. And we want to talk about, somebody said the screen has gone dark. So people can't see me, which is probably a positive thing. But sorry about that. Oh, somebody else said they can see me. Okay. Well, anyway, sorry. Maybe that was just a comment on what I look like instead of the slides. But yeah. Anyway, obviously, retail investors have had a bigger and bigger influence on the market. A lot of this discussion around financial advice is and ASIC regulations and everything else, I think is probably going to influence a lot of individual investors. So that's what we want to talk about today. So let's look at these two opposing camps that we have here. All right, so here we go. So on one side, of course, as I said, we have, and I switched the sides just to confuse everyone. On this left-hand side, we have the quote-unquote millennials who don't know anything. Which is how they're being portrayed by a lot of people who probably don't have a lot of empathy for new investors. And one of the leading finfluencers on the sort of millennial side of the camp is a woman named Victoria Devine. And we're going to do a podcast episode that goes a little more into this, but I've got a quote from her on the top of that page. And basically, Victoria Devine put this TikTok video together talking about that if you start saving $500 a month when you are 20, you will be able to take $115,000 a year out of your portfolio at 60. And if anyone has been on TikTok, it is obviously generally not used to provide a lot of detail, and she missed out on a lot of detail. And basically her whole assumptions there are pretty preposterous because it would involve a very, very high withdrawal rate when you're 60, that at least in my opinion, guarantees that most people would run out of money before they die. But anyway, the point is that there is this idea with a lot of these influencers that their purpose, and this is her quote, so this is her responding to a question on TikTok where somebody rightfully asked, hey, have you taken inflation into account? And she says, well, no, it's too complex for TikTok. If you start talking about inflation, and this is about motivation. And we'll talk a little bit more about what I think the ramifications of that is. But the two things I think that ASIC is probably certainly looking at is, number one, the qualifications of the people giving the financial advice, then the financial advice that they are providing, and the mediums with which they're using to do that. So Victoria Devine, interestingly enough, is actually licensed. So she is a financial advisor down in Melbourne. I don't know how much, well, I won't say that. She is a financial advisor down in Melbourne. She has one of the most popular, probably the most popular investing podcasts in Australia called She's on the Money. In my opinion, far inferior to Investing Compass, but I could be biased there. So she's probably the most popular. She's been in the crosshairs a lot of this whole discussion because she is using social media to provide financial guidance and financial advice, but she's actually licensed. A lot of the other people are not licensed. And I just grabbed a couple screenshots that I think are just examples of the pretty poor advice that is being given on these different platforms. I think I said in the Bubbleville article that this is a case where the teachers are truly only a couple pages ahead of the students. So what do we have here? Just examples. We've got a couple things around diversification. People who seem to think that ETFs are an asset class or managed funds are an asset class. So I think a little bit of confusion around diversification. This is my favorite one. It's hard to see, but this post talks about types of stocks. And it says small cap stocks are anything that's trading under $5. So, of course, the fact that you're on here hopefully means that you understand that it refers to market capitalization, nothing to do with the actual price of the share, which is irrelevant. Then on the other side of this thing, we have, of course, the sort of financial advice industry and sort of ASIC getting in the middle. So Joe Longo, who is the new ASIC chairman, was testifying in front of Parliament a couple of weeks ago. And he issued this quote that after a lot of pressure and a lot of questions raised by the industry, he basically said, hey, if somebody's doing something and giving financial advice without a license, turn them in, which I think is an interesting approach. And a lot of this pressure is coming from the financial services industry, who, of course, see all these people turning to social media to get financial advice. Now, of course, it's pretty ironic that the financial services industry is saying that. We all remember what happened in the Royal Commission, where whether that's deliberately bad advice or I guess, ignorance of investing, a lot of people were hurt by financial advisors. A lot of people were defrauded by financial advisors. We've seen widespread changes happening to the industry, which we'll get into in a second, because of that. So a lot of the millennials, of course, come back. The millennial influencers come back and say, okay, pretty ironic that these people are criticizing us, just like I did, for not exactly knowing what we're talking about, when whether they did or didn't, they defrauded a lot of their customers. And I think we can all be pretty embarrassed by what happened and what was uncovered during the Royal Commission. The other thing that's happening, of course, is we are seeing huge reductions in the amount of financial advisors, which is, I think, another ironic point. is that, as you can see from the article, because education standards, and this is irony as well, because education standards were introduced and because there are higher regulatory costs, because financial advisors were basically doing pretty terrible things to their clients, a lot of people are just quitting the business, which is interesting. And I do want to say that personally, and at Morningstar, we believe in the power of financial advice and the effectiveness of financial advice. But obviously, those are good advisors. There are some advisors that have left a bit of a stain on the industry. But the important thing is that because there are less financial advisors, because the cost of advice has gone up, there are a lot of Australians that are not even able to access financial advice, particularly young people who at this point have not built up enough of a portfolio. So what I'm trying to get across here is that in this match against the old, out-of-touch white men and the young, ignorant millennials, I think it's safe to say that they're probably both right and both wrong, because we do have, and we've created a situation in this country where financial advice is not available in an affordable form to people that actually need it. So, of course, somebody else is stepping Now, I obviously have some problems with the qualifications of some of these people. Many of these influencers are actually marketers. And I think many of them hide behind this Victoria Devine quote that this is about motivating people and not necessarily providing financial education. And the problem, of course, is that with investing, the only way that investing works is if you do it for a long time. So I'm a little bit worried that people are getting expectations set and getting a base of knowledge that isn't accurate, which means they will not stick with it. But once again, we will see what happens. All right. So where does this leave us? We actually have a question. No, it's from Lisa. Well, I'll get to your question, Lisa, but thank you. If anyone else has questions, let me know. Let's see. What are we going to talk about next? Okay, so let's talk about some of the issues for potential investors here. So one of the issues is that historically, if we go back and look at surges of new investors in the market, generally equate to times where it isn't necessarily good to invest. And this happens a lot, obviously, at the top of bubbles, where everyone piles in, the market goes through one last surge, and then things fall apart. So we've got a couple of examples, and obviously remember, we've had 2 million new investors in Australia in the last couple of years. So yeah, what impact are they actually having? Well, let's go back historically and look at a couple of things. So I've talked about both these examples before, and we can go back to almost every crash that's happened and every bubble that has occurred and see the same thing. So if we look at going back to the Nifty 50 crash, which I talk about a lot, and so that's what happened in the early 70s. So assets in mutual funds, so managed funds in the US, which sort of led this crash. So from 1960 to 1965, the assets in managed funds doubled. 65 to 70, it doubled again, and it peaked in 1972. Early 73 is when the market started going down. Same thing happened in 2000. So in the year 2000, once again, the dot-com bubble. So $260 billion went into US equity funds. And that was up from 150 billion in 99, 150 billion in 98, 176 billion in 99. So once again, we saw this huge surge right as the market was about to pull back. And if we go look at the dot-com bubble, which I think has a lot of parallels with what's happening today, who lost money in that? Generally, it was sort of everyday investors, because they got more and more aggressive as the bubble continued to expand. And so 100 million in the US by 2002, 100 million individual investors lost $5 trillion. And a lot of them did not come back into the market after that. So what's happening now? Well, perhaps we're seeing some parallels. So, and I talked about this before, this is how retail investors are driving more and more of what's happening in the market. So $140 billion have gone into the stock market in 2021. So that's a 33% increase over the same period in 2020. 2020, individual investors accounted for 20% of U.S. equity trading volumes. January of 2021, that was 26%. Historically, it's been around 10%. So huge increase in retail money coming into the market. And then final stat that Goldman Sachs just put out, they said that they estimate that households currently allocate 44% of their total assets to equities. And that is slightly behind the all-time high, which is 46% in the year 2000. So once again, sometimes when we get into these situations where retail investors are piling into the market, which is certainly what we've seen sort of across the board, but also particularly with all these new millennial investors, that is a case where potentially this could be another indication that we're getting to the place where the market might start turning over. So Sally's saying, Mark, do you know that you're not sharing your screen? I do. So I don't have any slides on this. I, put together a slide of the old white man and thought that was enough. So the next, so I'm just talking. So sorry that you have to look at me, but yeah, you can turn your computer around so you don't have to see me. Next thing that I think that we can all learn as investors from this is new investors are obviously relying on social media for advice, and at least in my view, that means that they may have unrealistic expectations about market returns. So what is that going to do? Well, two different things. One, I said before, the ability to stick to investing over the long term, which is actually when you get all of the benefits. So remember, compounding. So compounding is earning a return on a return. If you look at any sort of long-term saving, investing, and earning a return scenario, where is the vast majority of your returns going to happen? They're going to happen in the last couple of years. And that's just because of compounding. The compounding has been described famously by Warren Buffett as a snowball rolling down the hill that gathers more and more snow as it goes. Well, as the surface area, of course, gets bigger, the most snow it's going to gather is right at the end of the hill. So that is one thing about compounding. The other thing about people that are getting advice from people on social media is, of course, their ability to have some resilience in the face of market drops. So both of those, I think, are a little bit concerning. And one of the things I think we need to think about is just social media in general. So I'm not an expert, although I have like 10 friends on Instagram. But study after study, of course, indicates that social media leads to increased anxiety. Certainly people are portraying lives on there that may not actually exist. And that is creating this whole notion of fear of missing out. So this is happening with everything. It is also happening with investing. And so if you sit there and look at some of these finfluencers and the way that they are portraying their own lives, so one of the key things that a lot of them do is they keep their net worth updated in their profile and go through these net worth reviews every month. And I'm not saying people shouldn't do that. I'm just questioning whether that is just a motivation technique or whether that is something that is actually negatively influencing people that are following them. But yeah, that is so that's certainly something that social media in general does. But we've seen the impact of all of this across sort of the expectations game, that people that have been investing since the GFC have only seen the market go up. And of course, there is an assumption that that's going to keep happening. And it's not just millennials that think that. So we'll talk about recency bias in a second, but there's a study that I read that was pretty interesting from Natixis, which is a global asset manager. So they surveyed households that have over $100,000 in investable assets in March and April of this year. And those investors reported that they expect to earn 17.3% above inflation in 2021. Which, hey, may happen, may not happen, but the fact that those are return expectations is going to lead to a lot of people to be very surprised when they get nowhere close to that over the long term. So yeah, that's certainly a concern. But let's talk about recency bias. Is this just impacting these millennial investors? So it's easy to sit there, as I did, and look at some of the advice and some of the content that's being put out in social media and criticize it. But this is probably something that's going to affect all of us. So recency bias is one of the behavioral issues that people face when investing. And basically all that means is that investors are susceptible to basing investing decisions on recent events. So how actually prevalent is this? So of course there was a study done, and the study looked at trading decisions of individual investors at different brokers. So different types of brokers, all looking at retail customers. And they found that investor buying decisions seem to be swayed by past returns of investment. So the investments that were purchased by all these investors in the survey outperformed the market by 40 percentage points over the 2 years prior to them purchasing it. So this is once again chasing returns. So things that have done well in the recent past, people have decided they are going to continue to do well in the future. So that is a case where people are certainly chasing returns. Of course, what happened in the long term? This didn't work. So the stocks that the investors sold to fund these new purchases outperformed the ones that they bought over the next year. So this is a case of obviously recency bias. So we all need to be attuned to that, especially after what has happened since the GFC, where the market has basically gone up. And yes, there has been this market dip that occurred in March of 2020. But remember, that was very, very quick. And the market started, as soon as it hit bottom in late March, started going up again. So I do think that we're all susceptible to a little bit of recency bias. All right. So we've got a couple questions. So if people have other questions or concerns about seeing me on the screen, please send those in. All right. So Lisa has a good question. So she says, are younger investors growing in number due to the unaffordability of the property market? Okay. So yeah, probably. I think there's a lot of different factors. So certainly that is one of them, where there are a lot of people obviously that look at property prices in Australia and essentially give up. And there's certainly reasons for that. So instead of saving for purchasing a first property, yeah, people are probably putting money into the stock market. I think there is this, and once again, there's sort of this substitution bias or substitution effect that's happening probably with property, people who can't afford property, certainly looking at bonds and cash. And what you're getting off of those. So I think that is driving a lot of people in the market, both older investors and younger investors. But yeah, we're certainly seeing that. And I think one of the very good things, and once again, I've been a little bit talking about a lot of these influencers, but the fact that the millennial generation and Gen Z generation is getting interested in investing is a very good thing. And I think that we do need to be careful to make sure that we have empathy for the end investors that are just trying to make their future a little bit better, while we can retain criticism for the people that are giving them this guidance. And one other thing that I will say around sort of the guidance that people are getting from social media is a lot of these people are making money. So this is not some charity act of them putting out whatever the quality is, information and trying to motivate people to investing. A lot of people certainly are amassing these audiences, and then they're selling products to them. So they are selling both investment related products. So a lot of investment firms are obviously going out and understanding that there is this huge audience, an audience that's interested in investing, and they are marketing through these influencers. So they're selling investment products, and they're also just selling regular products, which I always think is interesting. So even Victoria Devine, who is licensed financial advisor, she's selling everything from underwear to savers, BPay. She's selling all sorts of kind of non-financial products, which is interesting. So it is important to realize that there is a reason. My internet connection is unstable, which is similar to me. So at least we fit in together. But anyway, there is certainly a benefit that these people are getting from this. So that's important to remember. All right, so a good question by Wayne. So Wayne's saying, I'm a long-term investor. However, some stocks are being pushed well above fair value due to current momentum. Should we sell and buy in again when the market falls? Okay, well, once again, Wayne, I'll say my same thing. I guess it wouldn't count today because I could not go out on my boat if I owned it. But yeah, if I knew obviously what the market was going to do or would do, I would be off on my boat and not here. But listen, I think I would be very careful about valuation levels at this point. Of course, what you are describing is timing the market, and we do need to be careful that we do in timing the market, because generally that does not work out very well for investors. But what I would say is think about, and we'll talk about this on Thursday, actually, we're going to do that portfolio construction one again. Think about your goals and think about the return that you actually need to achieve your goals. So rather than simply projecting what has happened out into the future, so if you look at that survey that I talked about with Natixis, where everyone thought the market, or everyone thinks the market's going to turn 17.5%, in 2021, which is up a little bit from 15% in 2020, something like that the U.S. market went up. Rather than simply projecting these returns out into the future, I would take a step back and look at what are your actual goals that you need to meet. What are the returns that are needed to meet those goals? And maybe that's a little bit of a better way of looking at it. Now, I personally, and certainly don't do what I do because I'm not on a boat. I'm sitting in my little apartment in Surrey Hills. I personally have built up some cash just by going through that process and looking at, okay, as markets have outperformed what I expected them to do, that brings down my required rate of return. It means that I can switch up, at least temporarily, my asset allocation and have more cash. Now, whether that means that I'll be able to reinvest when the market is cheaper, or if it just keeps going up, at least in my mind, either way, that benefits me. Something to think about, Wayne. Okay, so we've got a good question from Byron. So isn't the bubble going to keep building because there's so much money in the economy and very low return on cash and bonds? Yeah, it's interesting. This guy, Ray Dalio, who runs Bridgewater, which is the largest hedge fund in the world, just put out a little video on that. And basically was talking about, if you think stocks are cheap, if you think stocks are expensive, look at bonds. And basically saying that, the valuation level on bonds is so low. So basically the interest rate that you're getting effectively as a bond valuation is so low or so high. The interest rates are so low. The valuation levels are so high. The stocks actually look relatively cheap compared to them. I think that has fueled a lot of what has happened. What I will say is, be careful for when that changes. I think that certainly is justified in many ways, everything that has happened so far, but that's not going to last forever. And we've sort of seen the Fed already talking about, okay, we're now pulling in when we expect to raise interest rates a year earlier than what they originally said. I think we might start to see some of this. And just remember, if we continue to see this sort of upside in inflation, we could see rates go up, and we could sort of see that equilibrium change. I certainly get that people do not want to put money into bonds and do not want to put money into cash. The one thing I will say is, just remember that cash does have a purpose, and that purpose can be giving you opportunities and all dry powder for the future. Okay, so we've got a question from Sanjay saying, Mark, I'm afraid to get in the market due to a potential bubble. So hopefully you're just not listening to me and seeking out other opinions. Do you think it's a good plan to wait? Yeah, once again, I think it all depends upon your financial situation. And we did a podcast episode a couple of weeks ago, and we sort of talked about this whole thing and talked about, Shani and I sort of walked through our own personal situations. And, there's a lot of factors involved. So, number one is, how old are you? How long is your investment horizon? So I think, Shani, and I think it's a really good point, said that, given her age and given the horizon that she has until she's going to retire, which was the goal she was talking about. And for her purposes, it makes sense to set a plan, dollar cost average into that plan as she gets paid, and then saves money. And that's the best approach. So that certainly makes a lot of sense to me if you've got a very long time horizon. If you were getting closer to retirement, you could get very worried about potential volatility and what that would have to do with your time plan. So maybe in that case, you would want to be more cautious. And then if you're sort of in the middle of your investing career, which I generously say, even though people keep telling me it's going to be the end, that's a situation. Well, hey, is there like an intermediate step you can take where you still are mostly invested? Most of my net worth is in the stock market, but at the same time, potentially building up cash either through new savings or potentially just income you're generating from your portfolio. So as dividends get paid off. So yeah, I mean, I think it's hard to say, Sanjay, obviously, without knowing your personal situation. I couldn't offer personal advice anyway. But yeah, what I will say is sort of start with your goals and start with what you're trying to accomplish, and then look at that decision within those confines. Okay, so we've got a little bit of the other question. Everyone wants me to say when you should actually invest, which is hard. We got this question from Herman saying, do you think that given the current market valuations, would it be better to invest in international shares, ETFs, or Australian shares, ETFs, or should we patiently wait for a market correction? Yeah, once again, sorry, not to be a broken record, but it does depend upon your personal situation. So what I would do is spend some time and tune in Thursday if you've got some time on your hands, which I know a lot of people do. Tune in Thursday, we'll go through that whole process of setting goals and then how that translates into a required rate of return and how that actually translates into putting together a bit of an investment plan. So I think that is the best approach. First of all, let's figure out what we're trying to accomplish. In terms of sort of international shares versus Australian shares or ETFs, I can talk in general about kind of what you're facing in both markets. So obviously, if you were investing just in an ETF, you're most likely investing in an index fund, although there are active ETFs. So let's look at what we face in both markets. So number one, obviously, if you are investing in the Aussie market, the vast majority of the market, well, close to 50% of the ASX 200 is made up of resource companies, so miners, Rio Tinto, BHP, et cetera, and banks. So just realize investing in an Aussie index ETF, that is what you're getting. And think about those different industries and what are the different drivers of that industry. Because you're obviously not picking specific stocks. You're not figuring out if you think Westpac is better than Combank, which keeps going up. But yeah, think about what you're investing in. What are the different things that could influence banks and the profitability of banks? So one thing I will say is of industries, in a rising interest rate environment, banks actually do okay compared to other industries. U.S., what are you investing in? A lot of what you're investing in, if you're looking at the S&P 500, is you are looking at certainly technology companies or technology-like companies that are in the communications sector, like Google, Facebook, et cetera. Valuations are high. Certainly in those industries. But yeah, that's kind of the thinking that you need to look at. And then of course, if you're investing internationally, you are certainly going to be influenced, if you're not in a hedge portfolio, by the Aussie dollar. So the US dollar is actually rallying a little bit right now. And remember that if you are an Australian investor that's investing overseas, in the US, that's not a bad thing, right? You want the Aussie dollar to go down. So the Aussie dollar going down benefits you investing internationally. All right, so we've got a comment. This is the part that confuses me where I have to go onto the comment. But, okay, what do we have? Oh, somebody says they can't watch on an iPad, switch to PC. PC screen resolution isn't great, but watchable. Oh, geez. I look bad enough in good resolution, so I apologize for that. Not sure what's happening on the iPad. Okay, so we've got a question saying, with financial advice being unaffordable, where can investors without a large balance turn for guidance that they can trust? you think the number of unadvised and inexperienced investors in the market will exacerbate a downturn if and when it happens? Okay, two very, very good questions. Yeah, it's a really tough situation. So once again, with financial advice, we have seen a huge increase in the cost as a lot of the regulations that came out of the Royal Commission have started to get implemented. So it now costs more. There are less advisors. So guess who's actually getting financial advice? It's obviously wealthier investors who may be more sophisticated. Obviously, having more money doesn't make you more sophisticated, but at least a lot of people that do have more money do have some more experience with investing, which of course doesn't mean they know anything. So I'm backtracking on that whole thing, but they're certainly the people that are getting financial advice. So where can you turn? Listen, I think the biggest thing that certainly I'm a proponent of, and we're a proponent of Morningstar, is spend some time figuring out yourself. And, I think whether you're using a financial advisor or not using a financial advisor, the way to protect yourself is, of course, your own knowledge. And so I think one of the problems that I have, and sort of with that quote that Victoria Devine put on there, one of the issues is that there is this notion that that you can deliver financial advice on a platform like Instagram or TikTok in these short little snippets of, or even financial education, these short little snippets of videos. Well, unfortunately, some stuff in life is actually complicated. You wouldn't want your doctor watching a TikTok video to learn how to operate on you. So I do think that some things are complicated. So I guess what I would encourage people to do is read a couple books, spend some time thinking about this. There's this famous quote by Warren Buffett that said, investing is simple but not easy. And, people quote that a lot, I think incorrectly. And they quote that to say, okay, we don't really have to know anything to invest. Well, let's think about Warren Buffett. Warren Buffett's best qualities is he's able to take very, very complex financial concepts and basically present them in a very simplistic way. And that takes talent, but the first thing you have to do is you have to understand the complexity to understand if it's something you should ignore or not. So yeah, I guess I would encourage people to sort of keep going, keep learning more about investing. There's certainly resources out there all over the place. I just wouldn't turn to TikTok. Yeah. So the other question is, do you think the number of unadvised, inexperienced investors in the market will exacerbate a downturn if and when it happens? Yeah. Listen, I think it's very easy to sit there and say, you see this every single time. You see people that start investing right at the sort of top of a bubble. And yeah, a lot of them are obviously going in with very, very high expectations. And those high expectations are from recency bias. They've seen the market go up a ton, and they expect that to continue. So when those expectations are not met, you get a lot of panicked selling. And remember that if we just sit there and look at, and this is retail trading volumes, but if we sit there and look at how retail investors are becoming more and more part of the market, or bigger influence on the market, I have some worries about what's going to happen if the market starts falling and falls significantly. So is this a case where a correction could turn into a bear market, could turn into a 50% loss? Yeah, maybe. And we saw a little bit of this behavior kind of in February when the market started going down on a lot of these message boards. And obviously this is not a study of anything. This is just my own observations. There were a lot of people in the market were down, 2, 3, 4, 5%, something like that. And there were a lot of people on these boards that were basically like trying to encourage each other to hang on, buy the dip, all this stuff. And, I obviously thought back to other dips that were a little more substantial, like when the NASDAQ went down 70% after the .com bubble burst. So yeah, I think it's a worry, especially because there's a good Wall Street Journal article the other day talking about how volatility has essentially disappeared from the market as well. Basically, that the market hasn't had a down day of 5% in a pretty long time at this point. So I think complacency could start to build in. And remember that if this is the environment that people, whether they're experienced investors or new investors, are used to, volatility and a drop could provide a bit of a shock Okay, really, really good comment by Martin, which I 100% agree with, which is why I think it's a good comment. So he says, perhaps we should push our politicians, I can't say pollies as without being an Australian. I mean, I'm officially an Australian, but without having the accent, I feel like I can't say pollies. So I'll say politicians. Perhaps we should push our politicians to introduce financial literacy in the schools. Part of that education will include how to sort different types of advice and where to source it from. Would have saved me a lot of time. Yeah, no, I agree. I think this is once again where it's easy for us to sit there and be critical of, number one, the sort of influencers that are out there that are putting out this guidance and advice, and then the people that are taking it. But I think it's fair to say, as a society, we've certainly failed, this generation and multiple other generations around investing, right? The difference is that nowadays, more and more of this is being pushed onto you. Even if we think about Australia, we think about the transition from a situation where most people got a pension, which is a defined benefit plan, to super, where you have to make your own decisions. We have not introduced, number one, a financial advice framework where most Australians can go out there and get financial advice. And two, yeah, we've certainly failed people from an education standpoint, because financial literacy is not something that's taught in school a lot. So yeah, I agree. Okay, so good question by Bill. So Bill says there appears to be a move away from value shares at the moment. Banks are down and technology is up. You see a fundamental change in the market towards growth. Okay, so yeah, interestingly enough, so obviously if we go back and we look at what's happened since the GFC, growth has outperformed a lot. So we have seen a huge shift out in growth. And I think that this is also not just for new investors, but for any investors who have come of age during this time period. Basically, the way that you made money is you went further out on that growth, that risk spectrum, and you made more money, right? And now what we've seen since October is we've seen a bit of a rotation back. And it's really this point that journal article was talking about. There's a lack of headline volatility in the market and how the market's bouncing around. But there has been some pretty big moves from growth back into value. So I don't know if we're seeing a rotation back into growth, but I think people are certainly hedging their bets a little bit there. So remember, when the dot-com crash happened, and once again, I can't quote the exact numbers, but when the dot-com crash happened, value indexes in 2001 actually went up. And the losses that you saw in overall indexes, particularly in the NASDAQ, were really due to one sector collapsing. So I don't know if people are looking at that and thinking that maybe this is a time to rotate back into value, but we have seen that. So yeah, I don't know, Bill, if that's what's happening. Okay, let's see. All right, we've had lots of questions, so this is good. So the anonymous attendee, which is our favorite attendee, is asking a Morningstar question. So I will quickly answer this one. Can you please let me know the difference between Morningstar's premium site in the US and Morningstar's Australian site? Well, I run the team in Australia that does the site, so obviously it's better. So that's the big difference. But the question is, does Australian site have info on US share funds and ETFs? Okay, so we do get this question. All right, we have global equity research, so we have 1,600 stocks, so we cover globally: US, Asia, Europe, Australia. You get access to all of that on both the US site and the Australian site. Then the US site, you get access to US funds and ETFs. So mutual funds are domiciled in the US, which are very hard for Australians to access, and US ETFs, which are pretty easy for Australians to access. All you need is an international brokerage account. So you get that in the US. In Australia, you get Australian ETFs, Australian managed funds, and of course, New Zealand as well. You can get access. So we're starting to make changes because I have gotten a lot of feedback that people would like access to US ETFs. We're working it out. What we have recently done is we've added them, enabled them from share site portfolios that are pulled through, and you can actually access the research through that. So if you buy a US SPDR, SPY is the S&P 500 first ETF that was in the US. So if you buy that in the US, it's in your ShareSite account, brings back into Morningstar Premium. You can access our research through there. What we're working on now is how to make them searchable. So we will implement that. We just want to make sure that it is done in a straightforward manner so that people do not get confused about what they can and cannot trade locally. But there is a lot more interest in US ETFs now, particularly because there's more choice. There are more ETFs in the US, so if you are looking to access specific parts of US domestic markets or international markets, you can do that through ETFs. The other big difference that you get in Australia, joking aside, besides me, is you get ShareSite. So you get a subscription to ShareSite as part of your subscription to Morningstar Premium. Yeah, so anonymous attendee says, where can I get more information about Chinese and Asian markets and shares compared to info on US and Australian markets? There doesn't seem to be a lot of info and commentary on the Chinese and Asian market. Okay, we do of course offer research. So anything that we cover, so we've got a team of analysts in Hong Kong, anything that they cover from Asian markets, you do get access to that. Yeah, I mean, I think from a commentary perspective, yeah, you're probably going to get less. You of course do get access to our research on ETFs that invest in Asia and funds, but yeah, you probably do get you certainly get less. We do have an editorial team based here in Australia and a large one in the US, so that's where you're getting probably more commentary. And you know, I think yeah, I think that's a fair point. Okay, so we've got a question from the anonymous attendee, another tricky one. What's a reasonable rate of return over 15 to 20 years? Okay, so let's see how I can dance around this one. Yeah, I mean, I think somebody said they can hear my birds outside. They're not mine; they're free. They can do what they want. I do not keep any birds here. But thanks for that comment. Yeah, it's listen, it's a tricky one. So what I would say is what you can do is you can go back and look historically at market returns. So that is one thing you can do to see what a reasonable rate of return is over the next 15 to 20 years. What I would caution you on is you need to realize, in my point of view, we are coming from a lot higher of a valuation level. We are also coming after a time period where basically since the mid 80s, we've seen huge drops in interest rates. They bounced around a little bit, but the trend has been downwards. What that has done is it's inflated returns. So lower interest rates, raise valuations on equities. We'll do a how to value a share one soon, but that's basically the math behind it when you're discounting back cash flows by a smaller percent. So I would be very careful with looking at historic market returns. Start there, look at long-term market returns, but in my opinion, I would discount that by a couple percent, given sort of the environment that we're operating in. So if you are, once again, in my opinion, I would say that if you're looking at double-digit returns as what you're sort of expecting over the next 15 to 20 years, I think you're going to be disappointed. So I think I would move that back into single digits. And depending upon sort of the asset classes you invest in, I wouldn't get those single digits too close to 10%. It's my personal opinion. But yeah, start with historic returns over a long period of time. So don't obviously just look at what's happened since the GFC. And one thing to be very clear about that I think people have lost sight of what can actually happen. You look at equity returns in the decade of the 2000s, they were negative over 10 years. So just be careful. And remember, two things happened in that decade. There was a dot-com crash. So market crash in early 2000. So you started out with the dot-com crash. Then, of course, you had the global financial crisis. But still, that was a decade with negative returns. So just remember that stuff happens. I think that there's this notion that the stock market only goes up, but yeah, look historically, you can see that. All right, so Lisa has a good question. So she says, can existing financial advice companies boost their visibility by participating in the same media platforms as influencers? Yeah, so that's the example of what Victoria Devine is doing. And I gave her a little grief today, but I think she makes a very good point in one of these AFR articles about it, where she basically says that, yeah, I'm the only one, or one of the few people that are willing to do this. This is a way you actually engage with people. If we are going to create basically the ability to deliver advice at scale in Australia, we need to actually do this. So there's Victoria Devine, there's something called My Millennial Money. They are also licensed and they are financial advisors. So I think there is that opportunity. I think the problem is there's not a lot of appetite right now by most financial advisors to do this. Number one, because from a regulatory standpoint, it is a little bit murky. And then I think on the other hand, like, they don't need to, because at the end of the day, who are they targeting? They're targeting people that have a significant amount of money who can actually afford to pay their fees. So I think, so I think that's a question. So Pamela's saying a friend of my 20-something daughter did a podcast with Victoria Devine. In light of what you said about financial advisors using social media, should I encourage my daughter and friends to seek other avenues of investment knowledge? I've tried to encourage them to read Morningstar, but I feel it doesn't resonate with them as well. Yeah, hey, I think it's an important point, once again, to sort of defend what's happening on social media. The financial services industry in general has done a horrible job of being able to communicate with, frankly, anybody, but also certainly with young people. There is certainly this charge, which I agree with, that the industry is deliberately making things extremely complex because then, of course, you know that you need them. And I think this sort of notion, once again, talking about why Buffett is so popular, and Buffett's still pretty popular with young people, despite being, the quintessential old white man, is because he's able to put things in terms that people can understand. So I think the industry's has done a terrible job at it. I guess what I would say is it's fine, certainly, to start with learning and getting into this stuff through social media, but I would sort of quickly pivot into reading a couple books on this and just spending a little time thinking more and having more of a perspective. Now, I know that that's hard, and a lot of these things are more entertainment than probably value. Obviously, I like our own podcast, but I get it. Once again, it may come across as not as relatable. I mean, we try our best, and certainly, Shawnee's a real live millennial that we have on there. But yeah, I think that's potentially an avenue to get your daughter to move into, where, hey, let's look at some of these investing books. A lot of them are written in in an engaging manner. And once again, the book obviously has a little more heft than what you can get from a short video on TikTok. Got a question, what books you recommend? Send me an email at mark.lamonica1@morningstar.com. I'll send you a list of books. I've done that a couple times. Okay, so a couple more questions with 2 minutes left. So Chris is saying, are these social media influencers a global phenomenon, or international investment commissions also looking into regulating this area? And then he said something nice about my webinar. So thank you. This is certainly happening. It's certainly happening all over the place. I don't think there's nothing that I have seen where a regulator has sort of gotten this thing right. The one thing I will say, and I'm obviously more familiar with U.S. regulations, is that U.S. regulations are more relaxed. And this is part of the problem, right? So part of the problem is between sort of the personal advice provisions and the general advice provisions in Australia, there is not a lot of wiggle room to deliver what we would call scaled advice to people. So part of that is the regulations are just looser in the US. So there's sort of less of a impetus to do something. In Australia, the regulations are very, very specific around what you can and cannot say. So I think it might be a little bit just sort of looking at the regulatory environment and saying, okay, is this something that is appropriate given what's happening in the investment right now? All right, so let's. It's 2:00. The birds have gone away. But thank you guys for joining. Once again, on Thursday, we'll talk through that portfolio construction process, how to define your goals, and go through that process. And then hopefully we won't do too many of these from my apartment. But thank you guys for joining. If you have any questions, just email me at mark.lamonica1@morningstar.com. And if anyone's interested in reading those articles, I think if you just Google Bubbleville Morningstar, they'll show up. And yeah, let me know what you think. All right. Thank you guys very much.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.